I'm Craig Popp with Accrue Wealth, and this is Charts That Matter. The Federal Reserve cut interest rates for the first time in over 4 years, moving its benchmark rate 0.5% lower to support the labor market while working towards its 2% inflation target. The much anticipated announcement came on September 18th at the conclusion of the 2-day Federal Open Market Committee meeting. The rate cut lowers the federal funds target range to 4.75% to 5%. What I deem a more important outcome of this meeting was that the dot plot contained big revisions. The Fed's dot plot is a chart updated quarterly that records each Fed official's projection for the central bank's key short-term interest rate. The dots reflect what each U.S. central banker thinks will be the appropriate midpoint of the federal funds rate at the end of each calendar year. The dot plot is signaling an additional 50 basis points of cuts in 2024, another 100 basis points of easing in 2025, and 50 basis points of cuts in 2026. As a reminder, 100 basis points is equal to 1%. This will take the Fed funds rate range from the 5.25% to 5.5% target range to a range of 2.75% to 3% in 2026. In my opinion, this change has meaningful implications for investors holding a significant amount of their portfolio in cash. After over a decade of historically low interest rates, higher cash yields were a welcome development for many investors. Interest rates are higher across all cash instruments, including many savings accounts, certificates of deposit, and money market funds. Unfortunately, these short-term instruments quickly adjust when the Fed lowers interest rates. History shows that high yields on cash and CDs can evaporate rather quickly. Since 1973, there were 8 instances when cash yields dropped by at least 4% over periods ranging from 3 months to 2 years. The average decrease was about 5%. I have been referencing the next chart from BlackRock for many months. Bonds have been shown to outpace cash when the Fed stops hiking rates. This chart shows the average 12-month performance from January 1990 through February 2023 when the Fed holds rates steady. This rate cycle is interesting in that the time from last rate hike, which was July of 2023, to first rate cut, September of 24, lasted 14 months, the second longest in history. This led to a period where short-term rates were higher than long-term rates for a prolonged period. This chart shows the yield of the 3-month Treasury bill and the 10-year Treasury bond. As you can see, the 3-month yield was greater than the 10-year yield for a record 470 days. Historically, it has been rare for this to happen, less than 10% of the time. As such, let's see if the data in the previous chart holds true this cycle. This chart details the performance of money markets, short-term bonds, municipal bonds, and U.S. core bonds since the Fed's last rate hike in July of 2023. I want to conclude with the comment that cash is an essential part of any financial and investment plan. From a financial planning perspective, cash provides the liquidity needed to cover expenses and important life events. It's important to have enough cash to serve as an emergency fund in case of unexpected personal events such as injury or illness, or broader events such as an economic downturn. From an investment standpoint, cash can also serve important roles in reducing overall portfolio risk and by allowing investors to take advantage of attractive market prices. With that said, as investors, we must construct portfolios and allocate to asset classes where we think we will achieve the highest return for our risk profile. Don't be too comfortable being comfortable in cash.